Before we begin, it's crucial to understand that the information presented in this video is for educational and informational purposes only. I am not a financial advisor, mortgage broker, or accountant. The content shared here is not intended to be a substitute for professional financial advice. The home loan process is complex and unique to every individual's financial situation. You should always consult with a qualified and licensed professional, such as a mortgage loan originator or financial advisor, before making any financial decisions. Your reliance on any information in this presentation is solely at your own risk. You found it. The perfect house. The one with the backyard for the dog, the kitchen you can actually cook in, the extra room that's destined to be your home office. You can already see yourself living there. But then a cold wave of dread washes over you, because finding the house, that was the easy part. Now comes the real boss battle. The mortgage application. A soul-crushing gauntlet of paperwork, invasive questions, and the constant nagging fear of a single devastating word. Denied. What if I told you that over 8% of all conventional home loan applications in the United States get rejected? That's nearly 1 in 12 people who find their dream home, get their hopes up, and then have that dream shattered by a loan underwriter. And what if I told you that the #1 reason for that rejection isn't what you think? It's not always a rock-bottom credit score or a tiny down payment. More often than not, it's a simple lack of preparation. It's walking into the most important financial exam of your life without ever studying the questions. This video, this entire series, is your answer key. This is not another vague, 5-minute video telling you to save money and have good credit. This is the ultimate U.S. home loan qualification checklist. We are going to systematically dismantle the entire mortgage approval process, piece by piece, and transform you from a hopeful applicant into a lender's dream borrower. By the end of this series, you won't just be hoping for an approval. You'll be expecting it. You will walk into that lender's office with the confidence of a CEO presenting a flawless business plan, because that's exactly what your loan application will be. So let's start with the most important mindset shift you need to make right now. Stop thinking of yourself as someone begging for money. You are not. You are the CEO of a startup called Your Future Home Incorporated. The lender is not a gatekeeper. They are your first potential investor. And like any savvy investor, they need to see a solid, predictable, low-risk business plan before they write that massive check. Your job is to present them with a case so compelling, so buttoned up, and so professional that saying yes is the easiest and most logical decision they can make. Our checklist is the blueprint for that business plan. Let's build the foundation. Checklist item number 1. Become the undisputed master of your credit report. I know. You've heard it a million times. You need good credit. But good credit is a dangerously vague term. A lender doesn't just glance at your 740 FICO score and stamp, approved. They pull out a magnifying glass. They become financial detectives, and your credit report is their primary crime scene. They are reading the story of your financial life, and every single detail matters. They want to know, are you reliable? Are you responsible? When you make a promise to pay, do you keep it? Your credit report is your financial resume, and we are going to polish it until it gleams. Let's break it down into the 5 core components that actually make up that 3-digit number, because understanding this is the key to controlling it. First and most important is your payment history. This makes up a whopping 35% of your FICO score. It is the king. It is everything. This is a simple pass/fail test of your reliability. Do you pay your bills on time? Every single time? A single 30-day late payment on a car loan or a credit card from 2 years ago might seem like ancient history to you. To an underwriter, it's a giant flashing red flag. It's a crack in the foundation. It tells them that under a little bit of pressure, you might buckle. Your goal here is absolute perfection. 0 late payments in the last 24 months. Non-negotiable. Your action item right now: log into every single one of your accounts, credit cards, student loans, car loans, personal loans, and turn on autopay. Set it to at least pay the minimum on a specific day each month. Human error is your biggest enemy here. Automate your reliability. If you have had late payments in the past, the only cure is time and a flood of positive, on-time payments to push those mistakes further into the past. Second on the list is amounts owed, or what we call credit utilization. This accounts for 30% of your score, and it's the one you can influence the fastest. Utilization is simple. It's the amount of revolving credit you're using compared to the total amount of credit you have available. Imagine you have one credit card with a $10,000 limit, and you have a balance of $5,000 on it. Your utilization is 50%. To a lender, high utilization screams financial distress. It looks like you're living on the edge, relying on credit to get by. The golden rule, the number that will make underwriters smile, is to keep your overall utilization below 30%. But if you want to be a top-tier applicant and A+ student, you get that number under 10%. Let me show you how powerful this is. Let's say you have that $10,000 limit with a $5,000 balance. Your score is taking a hit. If you pay down that balance to just under $3,000, you cross the 30% threshold. Your score will jump. If you pay it down to under $1,000, crossing the 10% threshold, your score can leap even higher, sometimes in as little as 30 to 45 days. This is the fastest way to add rocket fuel to your credit score before you apply. Your action item. Add up the balances on all your credit cards. Then add up the credit limits on all your credit cards. Divide the total balance by the total limit. That's your utilization ratio. If it's over 30%, your primary mission is to attack that debt and get it down before a lender ever sees your name. Third, we have the length of your credit history. This is 15% of your score. Lenders are like old-school baseball scouts. They love seasoned veterans. They want to see a long, proven track record. A long credit history demonstrates stability. This is why the advice to close all your credit cards is one of the most destructive financial myths out there. When you close your oldest credit card, you're not just losing that available credit, which will spike your utilization ratio, you're also erasing your longest-running proof of good behavior. It's like a star quarterback voluntarily wiping his first 10 winning seasons from the record books. Your action item. Identify your oldest credit card. Protect it. Cherish it. Even if you don't use it, keep it open. Maybe buy a pack of gum with it every 6 months just to keep it active. Never ever close your oldest accounts, especially right before you plan to apply for a mortgage. Fourth on the list is credit mix, which makes up 10% of your score. The algorithm likes to see that you can responsibly handle different types of debt. There are two main flavors: revolving debt, like credit cards, and installment debt, like a car loan, a student loan, or a personal loan, where you pay a fixed amount every month. Having a healthy mix shows the lender you're financially versatile. You're not a one-trick pony. This is not something to panic about or try to game. Don't go out and get a car loan just to improve your mix. But if you have, say, only credit cards on your report, just be aware that this is an area where your score might be a little lower. It's simply about the system seeing you can manage different financial products successfully over time. Finally, we have new credit, the last 10% of your score. This is all about how recently and how often you've been applying for new credit. Every time you formally apply for a loan or credit card, it results in a hard inquiry on your report. 1 or 2 inquiries are no big deal. But if an underwriter pulls your report and sees 5 new credit card applications and a personal loan inquiry all within the last 3 months, alarm bells go off. It looks like you're desperate for cash. It's a sign of instability, the exact opposite of what they want to see. Your action item. In the 6 to 12 months leading up to your mortgage application, you enter a credit lockdown. No new car loans. No new credit cards. No financing a new sofa. Don't even let the cashier at the department store tempt you with a 20% off today offer to open a store card. Your credit profile needs to be as stable and boring as possible. You are in a quiet period. Your sole financial focus is on preparing for the mortgage. Mastering these 5 areas is the absolute, non-negotiable first step on our checklist. Pull your full credit reports for free from all 3 bureaus. Go through them line by line. Dispute any errors. Understand your utilization. Protect your old accounts. And stop applying for new credit. You are now the CEO. And your first order of business is cleaning up your company's financial history to make it pristine. Because once your credit report tells a story of unimpeachable reliability, we can move on to the next, equally critical item on the checklist, proving the one thing that turns that great story into a bankable reality: your income. And it's a numbers game, but it's also a story. Your credit report was the prologue, setting the stage by showing a history of promises kept. But a lender's biggest question isn't about your past, it's about your future. They're not just asking, "Did you pay your debts?" They're asking, "Can you pay our debt every single month for the next 30 years? And the only way to answer that question is with income. Stable, provable, and consistent income. This is where the rubber meets the road. It's the part of the process that separates the dreamers from the homeowners. Because it doesn't matter if you're a secret millionaire or get paid in cash under the table. If you can't prove it on paper, in a way the lender can verify and defend to their underwriters, it simply doesn't exist. So let's break down exactly how you prove your income, starting with the most straightforward path: the W-2 employee. If you receive a regular paycheck from an employer, congratulations, you're playing the game on easy mode. Lenders love W-2 employees. Why? Because it's simple. It's predictable. Your income story is written for you by your employer and the IRS, and it's a story lenders have read 1,000 times before. To prove it, you'll need 3 key sets of documents. First, your most recent pay stubs, typically covering a 30-day period. This is the snapshot of your current reality. It shows your hourly wage or salary, your year-to-date earnings, and any deductions. Proves what you're making right now. Second, your W-2 forms for the last 2 years. This is the highlight reel of your recent past. While the pay stub shows the now, the W-2s show the pattern. It demonstrates consistency. Did you get a raise last year? The W-2s prove it. Do you earn a significant amount in bonuses or commissions? The W-2s establish a history, allowing a lender to average that variable income over 24 months to create a predictable, qualifying number. They need to see that your success wasn't a one-time fluke. And third, your federal tax returns for the last 2 years. This is the ultimate verification. This is you, your employer, and the lender all agreeing on the same set of facts because you've already sworn to the federal government that these numbers are true. The tax returns tie everything together and confirm the W-2s are legitimate. For most W-2 borrowers, that's it. Pay stubs, W-2s, tax returns. You provide the documents, the lender verifies them with your employer, and your income is checked off the list. But what if your story isn't that simple? What if you're one of the millions of Americans who are self-employed, a freelancer, a gig worker, or a small business owner? This is where the process demands more from you. You're not just an applicant anymore. You are the CEO, CFO, an entire accounting department of You Incorporated. The lender isn't just evaluating your personal ability to pay. They're underwriting the financial stability of your business. Your income isn't a guaranteed paycheck. It's the net profit of your enterprise. And to prove that, you have to build an ironclad case. The gold standard for self-employed income is a 2-year history in the same field. Why 2 years? Because 1 year could be a fluke. 1 year could be a lucky break. 2 years shows survival. It shows you can navigate the ups and downs of a business cycle. It proves your income sources, in the lender's favorite words, stable and likely to continue. The documentation here is far more extensive. You'll need, at a minimum, your last 2 years of business and personal tax returns. All the pages, all the schedules. If you're a sole proprietor, that means your Schedule C, which details your business revenue and expenses. If you're in a partnership or an S-corp, it means your K-1s, showing your share of the company's profits. This is where so many self-employed buyers get a nasty shock. You see, for years, your accountant's job has been to use every legal deduction and write-off to lower your taxable income. And they did a great job. You wrote off your car, your home office, your supplies, your travel. You saved a ton on taxes. But when you go to get a mortgage, the lender looks at the bottom line of that tax return, the number after all those deductions, and says, "This is your income." The very strategy that saved you money on taxes can now sabotage your ability to qualify for the home you want. It's a painful paradox. However, all is not lost. A good loan officer knows that not all write-offs are created equal. They can add back certain paper loss expenses that don't actually affect your cash flow. Things like depreciation, which is an accounting concept, not cash leaving your pocket. This can sometimes boost your qualifying income, but it's no magic bullet. The best strategy is to plan ahead. If you know you want to buy a home in the next 2 to 3 years, you may need to have a very serious conversation with your accountant about taking fewer deductions to show a higher net income on paper. It might mean a bigger tax bill for a year or two, but it could also mean the keys to your dream house. Beyond tax returns, you'll need a year-to-date profit and loss statement, or P&L. If your last tax return was filed 8 months ago, the lender needs to know what's happened since. Is your business growing? Is it shrinking? The P&L tells that story. You'll also need your last several months of business bank statements to show the actual cash flowing in and out of the company, corroborating the story your P&L is telling. The lender will take all of this, 2 years of tax returns, your P&L, your bank statements, and perform a complex analysis to arrive at a single, average monthly income figure they can use for qualifying. It's a rigorous process, but it's how they turn the unpredictable world of entrepreneurship into a predictable number, they can plug into their formulas. Now, income isn't always just about a job. Many people have other sources of revenue, and these can absolutely be used to qualify. Do you have a rental property? You can use that income, but you'll need to show the executed lease agreements, and if you have a history as a landlord, the Schedule E from your tax returns to prove it. Do you receive Social Security, a pension, or disability income? You can use it. You'll need the award letter from the agency and proof of recent receipt, like a bank statement. Because this income is non-taxable, lenders can often gross it up, meaning they can increase it by about 25% for qualifying purposes, which is a huge advantage. What about alimony or child support? Yes, this can be used too, but the rules are strict. You'll need a copy of the divorce decree or court order stating the amount and duration, and you must provide proof that you have been receiving consistent, on-time payments for at least the last 6 to 12 months. Every piece of income you want to use must pass the same fundamental test. Is it stable, is it reliable, and is it likely to continue for at least the next 3 years? If you can prove that with documentation, you can use it. So you've gathered your pay stubs, your W-2s, your tax returns, your P&Ls. You've documented every dollar. You've successfully proven your income. But that's only half the equation, because a lender doesn't just look at what's coming in, they look at what's going out. This brings us to the single most important number in mortgage qualification, the debt-to-income ratio, your DTI. It's a simple concept. The lender adds up all of your monthly debt payments, your car loan, your student loans, your credit card minimum payments, and now your proposed new mortgage payment, including taxes and insurance. Then they divide that total by your gross monthly income, the number you just worked so hard to prove. The result is a percentage, and that percentage tells the lender how much of your monthly paycheck is already spoken for before you even buy groceries or pay for gas. There are 2 DTIs they look at. The front-end ratio is just your new housing payment against your income, but the one that really matters is the back-end ratio, which includes your house payment plus all your other debts. Generally, for a conventional loan backed by Fannie Mae or Freddie Mac, you want your back-end DTI to be 45% or lower. Some loan programs might stretch to 50%, but that's pushing the absolute limit. For an FHA loan, you might get away with a DTI in the low 50s, but it gets tougher. This is the final exam for your income. You can have a perfect credit score and $1 million in income, but if your DTI is 60%, you won't get the loan. It's the ultimate check and balance, designed to ensure you aren't overextended, and that the lender isn't taking on an unreasonable risk. So, before you even apply, you need to become obsessed with this number. Calculate it yourself. Add up your debts, divide by your income. If it's too high, you have 2 choices. Make more money or, more realistically, reduce your debt. Paying off a small personal loan or a credit card balance can have a massive impact on your DTI and dramatically increase your purchasing power. Getting your income documented and your DTI in line is a monumental step. It proves you have the financial engine to power a mortgage for the long haul. You've shown the lender your history of reliability through your credit, and now you've shown them your capacity to pay through your income. But there's one more pillar to this financial foundation. The lender needs to see that you have skin in the game. They need to see that you have the funds not just for the down payment, but for closing costs and for reserves after you close. You've proven you can earn it. Now you have to prove you have saved it. And that brings us to the next critical item on the checklist, your assets. Your assets. This isn't just about the number in your bank account. It's about the story that number tells. A lender looks at your income and says, okay, they can make the money. Then they look at your assets and say, but can they manage it? Can they hold on to it? Are they one broken furnace away from a financial catastrophe? Because when you buy a house, you're not just buying the 4 walls and a roof. You're buying the leaky faucet, the overgrown lawn, and the water heater that decides to call it quits a week after you move in. The lender needs to know you can handle that. They need to see a buffer. They need to see stability. Think of it this way, your income is your offense, it's how you score points. Your assets are your defense. It's what keeps you in the game when life throws you a curveball. So, when an underwriter pulls up your file, they are looking for proof of funds in 3 specific, non-negotiable buckets. Getting this right is the difference between a smooth approval and a frantic, last-minute scramble that can kill your deal. The first bucket is the most obvious, your down payment. This is the chunk of money you pay up front. Depending on your loan type, this could be as little as 3% for some conventional loans, 3.5% for an FHA loan, or as much as 20% or more if you want to avoid paying private mortgage insurance or PMI. We've talked about different loan programs, but the core principle is the same. You need to have your portion of the purchase price ready to go, in cash, sitting in an account we can verify. The second bucket is the one that trips up so many first-time homebuyers. Closing costs. These are the fees you pay to actually finalize the mortgage. Think of it as the administrative cost of this massive transaction. It includes things like appraisal fees, title insurance, attorney fees, loan origination fees, and prepaying some of your property taxes and homeowner's insurance. A good rule of thumb is to expect your closing costs to be somewhere between 2 to 5% of the total loan amount. Let's make that real. On a $300,000 home, you could be looking at an extra $6,000 to $15,000 on top of your down payment. This is not a small number, and it's why you hear horror stories of buyers who saved perfectly for their down payment, only to realize at the 11th hour they were thousands of dollars short. The lender needs to see this money in your account, separate from your down payment funds. They need to know you can close the deal. Now for the third, and arguably the most important bucket for demonstrating financial strength: reserves. Post-closing reserves. This is the money you have left over after you've paid your down payment, and after you've paid all your closing costs. This is your safety net. This is the lender's proof that you won't be financially wiped out the second you get the keys. They need to know you can make that first mortgage payment and the second and the third, even if your freelance gig dries up or you have an unexpected medical bill. How much do you need? The answer is calculated in terms of your monthly housing payment, or what we call PITI. That stands for principal, interest, taxes, and insurance. It's your total, all-in monthly mortgage payment. For most standard loans, a lender wants to see that you have at least 2 to 6 months of PITI in reserves. So, if your total monthly mortgage payment is going to be $2,500, you'll need to have an extra $5,000 to $15,000 sitting in the bank on closing day. For investment properties or more complex loan scenarios, that requirement could be 12 months or even more. So let's recap the 3 buckets: down payment, closing costs, and reserves. You need to have liquid, verifiable funds to cover all 3. But here's the critical part that most people miss. It's not enough to just have the money. You have to prove where it came from. This is where the concept of sourcing and seasoning comes in, and it is the single biggest landmine in the asset verification process. Every dollar you use for this transaction needs a paper trail. Lenders are required by federal law, including the Patriot Act, to verify the source of all funds to prevent things like money laundering. This means they will scrutinize your bank statements, usually the last 2 months' worth for all of your accounts. They're looking for any large, unusual, non-payroll deposits. Let me tell you a quick story. I had a client, let's call him Mark. Mark was perfectly qualified. Great income, great credit. He'd saved up for years. A week before closing, his grandmother, bless her heart, decided to give him an extra $10,000 to help with furniture. She wrote him a personal check, he deposited it and thought nothing of it. The underwriter saw this huge, unexplained deposit on his latest bank statement and slammed on the brakes. The entire loan was put on hold. We had to go back to his 90-year-old grandmother, who doesn't use email, and have her write and sign a formal gift letter, provide a copy of her bank statement showing the funds leaving her account, and prove she had the ability to give the gift. It was a stressful, frantic 72-hour fire drill that almost cost Mark his dream house. This is why seasoning is so important. Seasoned funds are funds that have been sitting in your bank account for a period of time, typically 60 days or more. Once the money has been in your account for over 2 statement cycles, the lender generally considers it your money, no questions asked. The source is seasoned. If you have money that isn't seasoned, like a recent gift from a family member, a bonus from work, or you sold a car on Craigslist, you must be prepared to document it. If it's a gift, you will need a signed gift letter from the donor stating the amount, the date, and explicitly saying that it is a true gift, not a loan that needs to be repaid. You will also likely need to show the money being transferred from their account into yours. And please hear me on this. Do not deposit cash. I repeat, do not deposit a large amount of cash into your bank account during the loan process. Mattress money is the biggest red flag you can possibly wave at an underwriter. There is no paper trail for a pile of $20 bills you've been stashing in a shoebox. To a lender, undocumented cash looks like an undisclosed loan at best, and illegal activity at worst. If you have cash savings, deposit it into your account months, long before you even apply for a loan so it has time to season. So what kind of assets can you use? It needs to be liquid and accessible. The most common are checking and savings accounts. But you can also use funds from a brokerage account, money market accounts, or even stocks and bonds. Keep in mind, if you're using assets from the stock market, lenders will typically only count about 70 to 80% of the value to account for market volatility. You can also use your 401k or other retirement accounts. You can often take a loan against your 401k or, in some cases, make a withdrawal. Just be absolutely sure you talk to your plan administrator and a financial advisor first to understand the rules, penalties, and tax implications. It can be a great source of funds, but you need to go in with your eyes wide open. Your job right now, before you even talk to a lender, is to become the forensic accountant of your own life. Pull up your last 2 months of bank statements for every single account you have. Savings, checking, Venmo balance, everything. Go through them line by line. Do you see any large deposits that aren't from your employer? If so, where did it come from? Can you prove it? Did you sell your old truck? Get the bill of sale ready. Did you get an insurance payout? Have the letter from the insurance company handy. Did your parents help you out? Get that gift letter signed today. Being proactive here is a game changer. Walking into the process with all your financial ducks in a row with every dollar accounted for shows the lender you are organized, responsible, and serious. It builds trust and makes the underwriter's job easy. And when their job is easy, your path to approval is fast and smooth. You've shown you can earn it. You've now shown you can save it and account for it. But there's one final piece to the personal finance puzzle. A piece that tells a longer, more detailed story about your history with debt and responsibility. You have to prove you can be trusted to pay it back. And that all comes down to one little 3-digit number that holds immense power over your financial life. Your credit score. It's your financial report card, your adulting GPA, the one number that tells lenders a story about you before you ever say a word. Think of it like this. When you apply for a loan, you're essentially asking a stranger to give you hundreds of thousands of dollars, based on a promise. Your credit score is the evidence that you're good for it. It's your reputation distilled into a single number. And for a mortgage, it's the master key that unlocks every other door. So what is this number, really? In the United States, when we talk about credit scores for mortgages, we're almost always talking about the FICO score. Not Credit Karma, not the score on your banking app. Those are usually Vantage scores, which are great for a general idea, but lenders use FICO. It's a specific formula that crunches all your credit data into a number between 300 and 850. A 300 means you're a financial ghost or have a history of serious trouble. An 850 means you're a credit unicorn, and lenders would probably offer you their firstborn child along with the loan. For the rest of us mortals, the numbers fall into brackets. Below 580 is generally considered poor credit. 580 to 669 is fair. 670 to 739 is good. 740 to 799 is very good. And anything 800 and above is exceptional. Now here's the million-dollar question. What's the magic number to get a mortgage? The answer is, it's complicated. The absolute bare minimum set by the government-backed programs are surprisingly low. An FHA loan, for example, technically allows for a score as low as 580 with a 3.5% down payment, or even 500 if you can put 10% down. A VA loan for veterans has no official minimum score set by the VA itself. But, and this is a massive but, that's not the whole story. This is where 99% of people get confused and frustrated. Lenders have their own rules on top of the government's rules. They're called lender overlays. Imagine the government sets the minimum height to ride a roller coaster at 4 feet. But the theme park itself, to be extra safe, says, nope, at our park, you have to be 4 feet 4 inches. That extra 4 inches is the overlay. Lenders do the exact same thing. So while the FHA says 580 is okay, your specific bank might have an overlay that says, we don't lend to anyone with a score below 620. Period. This is why you can be denied by one lender and approved by another, even for the exact same loan type. So let's talk real-world numbers. To even get in the game with most mainstream lenders, you'll want a score of at least 620. That's the unofficial floor for most conventional loans. But getting in the game isn't the same as winning. The truly life-changing differences happen at higher tiers. The difference in the interest rate you're offered between a 640 score and a 740 score could be a full percentage point, or even more. That might not sound like much, but on a $400,000 loan, that's a difference of over $250 a month. Every single month. For 30 years. That's over $90,000 in extra interest payments, just because of that 100-point difference in your score. $90,000. Getting your score up isn't just about getting approved. It's about saving a fortune. So how is this all-powerful number even calculated? It's not black magic. The FICO model is based on 5 key factors, each with a different weight. Understanding them is the key to mastering your score. The first, and the undisputed heavyweight champion of your credit score, is payment history. This accounts for 35% of your score. It's simple. Do you pay your bills on time? Every single late payment, whether it's 30, 60, or 90 days late, is a black mark on your record. It's a broken promise. A single 30-day late payment can drop an excellent score by 60 to 100 points overnight. And those marks stay on your report for 7 years. Lenders see a late payment, especially a recent one, as a massive red flag. They think, if this person can't be trusted to pay a $50 credit card bill on time, how can we trust them with a $2,500 mortgage payment? Consistency is everything here. The second most important factor at 30% of your score is amounts owed, or what's more commonly known as your credit utilization. This is a big one that you have a ton of control over. It's the ratio of how much you owe on your credit cards compared to your total credit limit. Imagine your total credit limit is a big empty room. Lenders want to see you using that room but not filling it with junk. If you have a $10,000 credit limit and you have a $9,000 balance, your utilization is 90%. That looks financially stressed. It screams that you're living on the edge. But if you have that same $10,000 limit and only a $1,000 balance, your utilization is 10%. That looks comfortable, responsible. You have breathing room. The general rule of thumb is to keep your utilization below 30%. The pro-level tip? Keep it under 10% for the biggest score boost. Next up, accounting for 15% of your score, is the length of your credit history. This is your financial resume. A longer history is better because it gives lenders more data to judge you on. An account you've had open and in good standing for 10 years is far more impressive than one you opened 10 months ago. This is why one of the worst things you can do is close your oldest credit card account, even if you don't use it anymore. Closing that account erases a huge chunk of your positive history and can cause your score to drop. Keep those old, no annual fee cards open. Just use them once every few months for a small purchase and pay it off immediately to keep them active. The fourth factor at 10% of your score is your credit mix. Lenders like to see that you can successfully manage different types of credit. There are 2 main types: revolving credit, like credit cards, and installment loans like a car loan, a student loan, or a personal loan, where you pay a fixed amount each month. Having a healthy mix of both shows you're a versatile and responsible borrower. It's not a deal breaker if you don't have both, but it definitely helps. Finally, the last 10% is new credit. This is all about how recently and how often you've been applying for new credit. If you suddenly apply for 5 new credit cards and a personal loan in the span of 2 months, you look desperate. It's a major red flag for lenders. Every time you apply for credit, it usually results in a hard inquiry on your report, which can temporarily ding your score by a few points. Now, the system is smart about rate shopping. If you're shopping for a mortgage or a car loan, all inquiries made within a short period, typically 14 to 45 days, are bundled together and counted as a single inquiry to avoid penalizing you for being a savvy shopper. But the key takeaway is this. In the year leading up to your mortgage application, stop applying for new credit. No new store cards to save 10% on a t-shirt, no new car loans, nothing. Freeze yourself. So let's make this real. The number one mistake people make is not knowing what's in their own story. You are legally entitled to a free copy of your full credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, once a year from annualcreditreport.com. This isn't your score. It's the detailed report card. Go through it line by line. Look for errors, fraudulent accounts, or late payments you don't recognize. Disputing and fixing these errors can be one of the fastest ways to boost your score. A powerful technique for a quick score boost if you have high credit card balances is something called the AZO method. All 0 except 1. You pay off the balances on all of your credit cards to 0, except for 1. On that one card, you leave a very small balance like $10 just to show it's an active account. This tanks your credit utilization ratio and can often result in a significant score jump in as little as 30 to 45 days. And please be careful about co-signing. When you co-sign a loan for a friend or family member, you are not just a character reference. You are 100% legally responsible for that debt. If they miss a payment, it's a late payment on your credit report. I have seen countless homeownership dreams shattered because someone co-signed for their cousin's car, The cousin missed a few payments, and the homebuyer's credit score plummeted right before they were supposed to close on their house. Don't let someone else's financial irresponsibility sink your dream. Your credit score is the story of your past promises. It's your track record of reliability. Getting it right is non-negotiable. But lenders aren't just looking at your past. They're making a massive bet on your future. And to do that, they need to scrutinize the one thing that actually pays the bills: your income and your job. But what they look for is far more complex, and frankly, far more judgmental than just looking at the number on your paycheck. They see your income not as a number but as a story. A story with a past, a present, and a future. And their job is to read that story and decide if it ends with you successfully paying off a $300,000 loan over 30 years, or if it ends in a foreclosure that costs them a fortune. This isn't about being mean, it's about risk. And to a lender, an unstable or unproven income story is the biggest risk of all. So how do they judge your story? They break it down into 3 core questions, the 3 pillars of income qualification. And understanding these is the key to unlocking the whole process. These pillars are stability, sufficiency, and sustainability. Let's break that down. First, stability. This is the backward-looking part of your story. The lender is asking, has this income been reliable over time? The magic number you always hear is 2 years. They want to see a 2-year history of employment and income. Why 2 years? Because anyone can get a great-paying job for 6 months. A year could be a lucky break. But 2 years shows a pattern. It proves that your income isn't a fluke. It's a trend. For most people, the W-2 employee, this is the easiest part. You provide your 2 most recent W-2s and your last 30 days of pay stubs. This is the gold standard for a reason. A W-2 from a third-party employer is clean, it's verifiable, and it shows a consistent history. It's the lender's equivalent of a sure thing. But what if you haven't been at the same job for 2 years? This is where a huge myth trips people up. You do not need to be at the same company for 2 years. What you do need to show is a 2-year history of being in the same line of work. If you were an accountant at firm A for a year and a half, and then you moved to firm B 3 months ago for a promotion and a 20% raise, that's not a red flag. That's a green flag the size of Texas. It shows career progression. You're not a risk, you're an asset. But if you were an accountant for a year and a half and 3 months ago you decided to quit and become a professional dolphin trainer, the lender is going to hit the brakes hard. Because your proven stable history as an accountant is now irrelevant. You've started a brand new story, and they have no evidence that this new story will have a happy ending. You'll likely have to wait until you have a 2-year history as a dolphin trainer before they'll even consider you. There's a massive exception here for recent graduates, and this is crucial for anyone starting their career. If you just graduated with a degree in nursing and got a job as a nurse, you don't need a 2-year work history. Your time in school acts as your history. The lender sees a direct line from your education to your employment, and they can reasonably assume you'll continue in that field. Your college transcripts literally become part of your proof of stability. So that's Pillar 1, stability, proving your past. Now for Pillar 2, sufficiency. This is the present-day part of your story. The lender is asking, is this income enough right now? This is where they look at your pay stubs and W-2s and actually calculate your qualifying income. And I say qualifying income because the number on your paycheck is often not the number the lender uses. If you're a salaried employee, it's simple. Your annual salary divided by 12 is your monthly income. Easy. But if you're paid hourly, it gets more complex. If your hours are guaranteed at 40 hours per week, it's straightforward. But if your hours vary, maybe you work 35 hours one week and 45 the next, the lender can't just use your best week. They will take an average. They'll look at your year-to-date earnings on your pay stub and your previous year's W-2 to calculate a conservative, stable average monthly income. They are always going to lean towards the more conservative, provable number. And this is where we get into the really tricky stuff, variable income. This means overtime, bonuses, and commissions. This is income that isn't guaranteed. And to a lender, not guaranteed is a 4-letter word. You might think that $100,000 bonus you got last year means you can afford a mansion. The lender thinks it might be a one-time fluke you'll never see again. To use any of this variable income to qualify, you must, and this is non-negotiable, have a 2-year history of receiving it. And you must show that it's stable or increasing. If you got a $20,000 bonus 2 years ago, and a $25,000 bonus last year, the lender will likely take a 2-year average and add that to your monthly qualifying income. But if you got a $25,000 bonus 2 years ago and only $10,000 last year, That's a declining trend. They will either use the lower, more recent number, or in many cases, they will disregard it entirely. They will not give you credit for income that appears to be drying up. Commission income is even more heavily scrutinized. Just like with bonuses, they need that 2-year history. But they also do something else, something that derails thousands of applications. They will look at your tax returns. Specifically, they're looking for something called unreimbursed employee expenses. If you're a salesperson who spends your own money on gas, meals, and marketing to earn your commissions, you probably write that off on your taxes to lower your tax bill. And that's smart. But the mortgage lender will take those write-offs and subtract them directly from your commission income before they calculate your average. So the very thing you did to save money on taxes can actually reduce the amount of house you qualify for. It's a brutal catch-22 that covers sufficiency, making sure the income you have right now is enough, and calculated in the most conservative way possible. Finally, we have the third pillar, the most judgmental one of all, sustainability. This is the forward-looking part of your story. The lender is asking, is this income likely to continue for the next 3 years? This is where they stop being historians and start being fortune tellers. How do they do this? First, the simple way. It's called a verification of employment, or VOE. After you're under contract on a house, someone in the lender's office will call your HR department. They will ask for your start date, your title, and your pay rate. But then they ask the killer question. What is the likelihood of continued employment? If your HR manager says anything other than very likely or good, it can raise a huge red flag. They are literally asking your boss if you're about to get fired. They also look at the nature of your income itself. Are you a contract worker whose contract is set to expire in 6 months? They'll need to see a history of contract renewals or a new contract already in hand to believe that income is sustainable. Are you in an industry that's rapidly declining? That can also, in rare cases, be a factor. This idea of sustainability, of proving your income will continue into the future, is the single biggest hurdle for a massive and growing part of the American workforce. We've been talking mostly about the W-2 employee, the person who gets a predictable paycheck from a company. But what about the person who is the company? The freelancer, the small business owner, the real estate agent, the YouTuber, the gig worker driving for Uber or DoorDash. The person who gets a 1099 instead of a W-2. For them, the entire rulebook is different. Their journey to income qualification is 1,000 times harder. The lender doesn't just look at their income. They perform a full financial autopsy on their business. Every single dollar of income must be proven, and every single business expense listed on their tax returns becomes a weapon used against them to lower their qualifying income. For the self-employed, the process is an absolute minefield, where one wrong step on a tax return from 2 years ago can detonate your dream of buying a home today. So how do you navigate this minefield? How do you turn the tables and use the underwriter's own rulebook to your advantage? First, you have to understand the battlefield. For a self-employed borrower, your tax returns are not just a report to the IRS. They are your financial autobiography, and the underwriter is the world's most critical book reviewer. Let's pull back the curtain on exactly what they're looking for. The core conflict, the central drama of your entire application, is the battle between your net income and your qualifying income. You and your accountant have spent years legally and brilliantly minimizing your net taxable income. You write off everything you can, your mileage, your home office, that new laptop, a portion of your cell phone bill. Every dollar you write off is a dollar the IRS can't tax. It's smart. It's what you're supposed to do. But the mortgage underwriter sees this differently. To them, every dollar you write off is a dollar you didn't really earn. They start with the bottom line number on your tax return, that net profit after all those beautiful deductions, and that's their initial battlefield position. If you're a sole proprietor, they're looking at your Schedule C. If you're in a partnership or an S-corp, they're dissecting your K-1s. And for them, a lower net profit means a lower ability to repay a loan. This is the fundamental disconnect that sinks so many self-employed applicants. They walk in thinking they're a 6-figure success story, and the lender's calculator tells them they barely make minimum wage. But here's where the tide can turn. Here is the secret weapon that most self-employed borrowers don't know they have. It's a concept called add-backs. Underwriters know that not all business expenses are actual, out-of-pocket cash expenditures. Some are what we call paper losses, deductions the IRS allows you to take to encourage business investment, but that don't actually represent money leaving your bank account that year. The single most powerful add-back is depreciation. Let's say you bought a $50,000 piece of equipment for your business. The IRS doesn't make you write that off all at once. They let you depreciate it, writing off a portion of its value each year for several years. Maybe you took a $10,000 depreciation expense on your taxes this year. That lowered your taxable income by 10 grand. But did you actually spend $10,000 in cash this year on that depreciation? No. The money for the equipment was spent years ago. It's a non-cash expense. A savvy lender will add that $10,000 back to your net income. Suddenly, your qualifying income just jumped by 10 grand. This applies to other things too. Amortization, depletion, and sometimes even one-time capital losses can be added back in. This is not a loophole. It's a standard part of the underwriting process. But it's your job and your loan officer's job to find these add-backs and fight for them. You have to comb through your own tax returns and identify every single dollar that was a non-cash expense. Don't assume the underwriter will find them for you. You have to build the case yourself. Now let's talk about the biggest trap of all, the 2-year average. Lenders want to see stability. A single great year doesn't impress them. It makes them suspicious. The standard procedure is to take your net income from the last 2 years, add them together, and divide by 24 to get your average monthly qualifying income. And this is where dreams go to die. Imagine this scenario. 2 years ago, you had the best year of your life. You cleared $200,000 in net profit. You felt on top of the world. But last year was tough. The market shifted, you lost a big client, and your net profit dropped to $100,000. You're still doing great, right? You made 100 grand. But the underwriter doesn't see it that way. They see a 50% decline in income. That's a massive red flag. In this case, they will almost certainly throw the 2-year average out the window and use only your most recent lower income. Or worse, they might see the downward trend as a sign of a failing business and deny you altogether. They will punish you for the decline. Now let's flip it. Say 2 years ago you made $50,000, but last year you knocked it out of the park and made $150,000. A 300% increase. You're a rising star. You'd think the lender would be thrilled. But again, they're skeptical. They see instability. Was last year a fluke? A one-time contract you'll never get again? They might average the 2 years, giving you a qualifying income of $100,000. But they might also say the increase is too dramatic, too recent, and they want to see another full year at that higher level before they'll give you full credit for it. They will question your success. The only scenario that gets a smooth ride is 2 years of stable or slightly increasing income. $50,000 followed by $60,000? Perfect. $100,000 followed by $110,000? You're golden. Anything else and you're in for a fight. You'll need to provide letters of explanation. You'll need to show that the bad year was a fluke, or that the good year is the new normal, backed by signed contracts for the coming year. And it doesn't stop with tax returns. The underwriter will then demand your business bank statements, often the last 12 to 24 months of them, and they will put them under a microscope. They are conducting a financial forensics investigation. They're looking for consistency between your stated income and your actual cash flow. If you claim you make $10,000 a month but your business account only shows $5,000 in deposits, you have a problem. They're also looking for large unexplained deposits. That $30,000 deposit last May? Was that revenue? Or was it a loan from your parents you're trying to pass off as income? You will have to source it, prove where every penny came from. And God forbid you commingle your funds. If you're paying your personal mortgage or your kids' tuition directly from your business account, you've just created a nightmare. An underwriter sees that as a sign of poor financial management. They will start to question the legitimacy of all your write-offs. They might even hit you with something called a business expense factor, where they look at your gross deposits and arbitrarily decide that, say, 30% of it must be expenses, and slash your qualifying income accordingly regardless of what your tax returns say. So what if your last tax year was genuinely bad, but this year is looking fantastic? Your last hope is a meticulously prepared, year-to-date profit and loss statement or P&L, along with your corresponding business bank statements to back it up. A strong P&L showing that you're on track to have a record-breaking year can sometimes, convince an underwriter to make an exception and give you more credit than your last tax return would suggest. But it has to be perfect. The numbers have to be believable, the cash flow has to match, and you have to have a compelling story for why the past is not indicative of the future. Mastering your income documentation as a self-employed individual is like learning a new language, the language of underwriting. It's about understanding that your tax return is a story, and you need to control the narrative. It's about anticipating every question, every doubt, and having the documentation ready to prove your case. Because even if you successfully navigate this income minefield and prove you make more than enough money, you're about to walk straight into the next battlefield. A battlefield where it's not about how much you make, but how much you owe. Welcome to the world of debt-to-income ratios, where every single monthly payment you have, from student loans to car payments, becomes another soldier lined up against you. And the general inspecting this battlefield, the lender, has one primary metric to gauge your chances of victory. It's not your credit score, not yet. It's not the cash in your savings account. It's a simple, brutal percentage known as your debt-to-income ratio, or DTI. This number, more than almost any other, tells the lender the story of your financial life. It's the answer to the question, can you actually handle this new mortgage payment on top of everything else? Or are you one unexpected car repair away from complete financial collapse? Think of it this way. Your gross monthly income, that's your income before taxes, before health insurance, before 401k contributions, the big number at the top of your pay stub, is your total supply line. It's all the resources you have coming in each month to fight your financial battles. Your debts are the resources going out. The DTI ratio is the cold, hard calculation of what percentage of your supplies are already spoken for, before you've even bought groceries or paid the electric bill. Lenders look at this in two different ways, a two-front war you have to win. The first is called the front-end ratio, or the housing ratio. This one is simple. It only looks at your potential housing payment. We're talking about PITI, principal, interest, taxes, and insurance. Add in HOA fees if you have them. The lender takes that total estimated monthly housing cost and divides it by your gross monthly income. For decades, the gold standard for this front-end ratio was 28%. If your new mortgage payment was going to be more than 28% of your pre-tax income, red flags would start to fly. Now that number has gotten more flexible, sometimes creeping into the low 30s, but the principle remains. Lenders want to see that the cost of your shelter isn't consuming a dangerously high portion of your income. But that's just the opening skirmish. The real war, the one that disqualifies most people, is fought on the second front, the back-end ratio. This is the big one. This is the one they really care about. The back-end ratio takes all of your monthly debt obligations, every single one, plus your new, estimated mortgage payment, and divides that total by your gross monthly income. What counts as a debt? Everything. That car payment? It counts. The minimum monthly payment on all of your credit cards? They get added up and thrown in the pile. Your student loan payments? Absolutely. Even if your loans are in deferment or forbearance, lenders don't just ignore them. They have to account for them. They'll typically use a standard calculation like 1% or 0.5% of your total student loan balance as your estimated monthly payment, and that number goes right into the calculation. Child support or alimony payments? You bet. Any personal loans, furniture store financing, anything that shows up on your credit report as a recurring monthly installment debt, it all gets tallied up and stacked against you. The magic number for this back-end ratio has traditionally been 36%. The idea was that no more than 36% of your gross income should be going towards servicing debt, including your house. But let's be honest, in today's world of high home prices and staggering student loan balances, 36% is a tough target for many. So the goalposts have moved. For a conventional loan, many lenders will now go up to 43%. Some might even stretch to 45% if you have a massive down payment or a near-perfect credit score. Get into the world of government-backed loans, and it changes again. An FHA loan might let you push that DTI all the way to 50%, sometimes even higher if you have what they call compensating factors. Things like significant cash reserves left over after closing. They're essentially saying, okay, your monthly budget is going to be incredibly tight, but you have a huge emergency fund, so we'll take the risk. But why are they so obsessed with this number? Because DTI is a predictor of default. It's their crystal ball. A low DTI suggests you have plenty of financial breathing room. If your car breaks down or you have a medical emergency, you have the cash flow to handle it without missing a mortgage payment. A high DTI, on the other hand, paints a picture of someone living on a razor's edge. You're house poor. Every dollar is accounted for. A single unexpected expense could send your entire financial house of cards tumbling down. And the lender does not want to be there to see that happen. They aren't just lending you money for a month. They are entering into a 30-year financial marriage with you, and your DTI is their assessment of whether you're a stable partner. So let's do the math. Let's make this real. Imagine a couple, Alex and Ben. Together, Their gross monthly income is $8,000. That's their supply line. Now let's look at their existing debts. They have a car payment of $450. They have student loan payments totaling $350 a month. And they have a few credit cards, and the combined minimum payments on those cards is $150. So their current non-housing debt is $450 plus $350 plus $150, which equals $950 per month. Now they find a house they love. After talking to a lender, they estimate that the full mortgage payment, will be about $2,200 a month. To find their back-end DTI, we add the new mortgage to their existing debts. So, $2,200 for the house plus the $950 in other debts gives us a total monthly debt obligation of $3,150. Now the final step. We divide that total debt by their gross monthly income. $3,150 divided by $8,000 equals 0.39375. To turn that into a percentage, we multiply by 100. Their back-end DTI is 39.4%. Is that good enough? For a conventional loan aiming for a max of 43%, yes, they're in the game. They have a little wiggle room. But if their car payment was $700 and their student loans were $600, their DTI would suddenly jump to over 45%, and that green light from the lender could instantly turn red. Every single dollar of monthly debt matters. This is why managing your DTI is the most strategic part of preparing for a home loan. So how do you lower it? You have two levers to pull, and one is far more effective than the other. Lever 1. Increase your income. This is the obvious one. Get a raise, get a promotion, or start a side hustle. The catch is that lenders need to see stability. A raise that started last week is great, but they're going to want to see the pay stubs to prove it. For side hustle or self-employment income, they won't even consider it unless you can show a 2-year history of it on your tax returns. So, increasing income is a powerful but slow strategy. Lever 2. Decrease your debt. This is the fast track. This is where you can make a massive difference in a matter of months. Look at your debts. Is there a small personal loan with a $150 monthly payment that you could pay off with your savings? Doing that doesn't just eliminate the debt. It permanently eliminates that $150 from the lender's DTI calculation. It's like freeing up a soldier for battle. The biggest killer for most people? Car payments. That brand new SUV with a $600 monthly payment might be nice, but it is actively reducing the amount of house you can afford by over $100,000. Lenders don't care that you only have 12 months left on the loan. If it's there on the day you apply, it counts against you. Paying off a car loan is often the single most impactful thing a person can do to improve their DTI. The strategy is simple. Attack the debts with the highest monthly payment relative to their total balance. Or use the snowball method and attack the smallest balances first to get quick wins and free up cash flow. The method doesn't matter as much as the action. Every monthly payment you eliminate is a direct boost to your borrowing power. And this brings us to the single most important rule when you are in the home buying process. Do not, under any circumstances, take on new debt. I have seen people get their pre-approval letter, think they are in the clear, and go out and finance a whole house full of new furniture or buy a new car because their old one wouldn't look good in the new driveway. This is the kiss of death. Lenders do a final credit check right before closing. When they see that new $500 monthly payment that wasn't there before, your DTI shoots up, your approval is revoked, and the entire deal falls apart just days before you were supposed to get the keys. Don't be that person. Put your financial life on lockdown until after the keys are in your hand. Your DTI is the blueprint of your monthly budget. It's the load-bearing wall of your financial house. Get it right and the whole structure is sound. Get it wrong, and it's only a matter of time before cracks begin to appear. So now you've mastered your credit, you've documented your income, and you've wrestled your debt-to-income ratio into fighting shape. You've proven on paper that you can handle the monthly grind. But the lender has one more question, and it's a big one. What happens when the unexpected strikes? Where's your safety net? It's not enough to be able to afford the monthly payment. You have to prove you can afford the entry fee. That means cash. Cold, hard, documented cash. Welcome to the world of down payments, closing costs, and the cash reserves that prove you're not just ready to survive in your new home, but prepared to thrive. Let's talk about the price of admission. Because before a lender hands you the keys to a $300,000, $500,000, or $700,000 asset, they need to see your commitment. They need to see you have skin in the game. This isn't just about proving you can make the monthly payments. It's about proving you have the financial stability to weather the initial storm of the transaction itself. First up is the most famous number in real estate, the down payment. For decades, a myth has been whispered at family barbecues and in office break rooms. You need 20% down to buy a house. Let me be crystal clear. That is one of the most persistent and damaging falsehoods in the entire home buying process. While putting 20% down is a fantastic goal with real benefits, it is absolutely not a requirement for the vast majority of homebuyers in America. Think of the down payment as your initial investment. It's the portion of the home's price that you pay up front, out of your own pocket. The rest is the loan. So, if you put 10% down on a $400,000 home, you're paying $40,000, and the bank is lending you $360,000. The more you put down, the less risk the bank takes. If you default, they have a larger equity cushion to protect them from losing money. This is why that 20% number is so significant. When you put 20% or more down on a conventional loan, you bypass something called private mortgage insurance, or PMI. PMI is an insurance policy you are forced to pay for, but it doesn't protect you. It protects the lender. It's the bank's way of hedging their bet on you because you're considered a slightly higher risk with less equity. It's an extra $100, $200, maybe even $300 tacked onto your mortgage payment every single month for years until you reach that 20% equity threshold. Avoiding PMI is the primary superpower of a large down payment. But what if you don't have 20%? Welcome to the real world. This is where modern loan programs become your best friend. An FHA loan, backed by the Federal Housing Administration, allows for down payments as low as 3.5%. VA loans for our honored veterans and service members, and USDA loans for eligible rural areas, often require 0% down. That's right, zero. Many conventional loans, the workhorse of the mortgage industry, now offer programs for as little as 3 to 5% down, especially for first-time homebuyers. The dream of homeownership is not reserved for those with $80,000 sitting in a savings account. But your down payment is just the opening act. The part that blindsides so many hopeful buyers is the second pillar of cash you need: closing costs. If the down payment is the ticket price, closing costs are the taxes, fees, and surcharges that you don't see on the poster. They are the unavoidable, non-negotiable costs of doing the business of buying a house. And they can be substantial. On average, you can expect to pay anywhere from 2 to 5% of the home's purchase price in closing costs. Let's do the math on that $400,000 home. That's an additional $8,000 to $20,000 you need to bring to the table, on top of your down payment. This is the moment where unprepared buyers see their dreams evaporate. So what are you actually paying for? These costs are a collection of fees paid to all the different professionals who make the transaction happen. There are lender fees like the loan origination or underwriting fee, which is what you pay the bank for creating the loan. There are third-party fees for services like the appraisal, which confirms the home is worth what you're paying for it. Title insurance, which protects you and the lender from any future claims on the property's ownership, and the home inspection fee. And then there are the prepaids. This is where you prepay for certain ongoing expenses, like your first year of homeowner's insurance and several months of property taxes, which are put into an escrow account. It's a long list, and you'll get an official document called a loan estimate that breaks it all down. But the key takeaway is this: your down payment is not the total cash you need. You must budget for thousands, potentially tens of thousands more. Forgetting about closing costs is like planning a cross-country road trip and forgetting to budget for gas. You won't get very far. Now you've accounted for the down payment. You've budgeted for the closing costs. You're ready, right? Not so fast. The lender has one final test of your financial fortitude. They want to see what you have left after you've paid for everything. This is the world of cash reserves. Reserves are your post-closing safety net. The lender needs to see that you aren't draining every last penny to your name to close this deal. They want proof that if the water heater explodes in month 2, or you face an unexpected job loss in month 6, you won't immediately default on your brand new mortgage. They need to know you can survive. The requirement is typically measured in months of your total mortgage payment. That's principal, interest, taxes, and insurance or PITI. For a standard primary residence, most lenders want to see that you have at least 2 months of PITI in a liquid, accessible account after closing. For a second home or an investment property, that requirement can jump to 6 months or even more. So if your new total mortgage payment is $3,000 a month, you'll need an extra $6,000 just sitting in your bank account, untouched, on closing day. This is the lender's ultimate stress test, and it's non-negotiable. So where does all this cash, down payment, closing costs, and reserves come from? This is where the concepts of sourcing and seasoning become critical. You can't just show up to the bank with a suitcase full of cash. Every single dollar has to have a paper trail. This is called sourcing. Lenders need to know where the money came from to ensure it's not from an illegal source or, more importantly, an undisclosed loan that would affect your debt-to-income ratio. The money must also be seasoned. This means it needs to have been sitting in your account for a certain period, typically 60 days, which covers 2 full bank statement cycles. This proves to the lender that the money is truly yours, and not a last-minute loan from a friend that you have to pay back. A large, random, undocumented deposit appearing in your account a week before you apply for a mortgage is one of the biggest red flags you can raise. Mattress money is a mortgage killer. It creates a nightmare of paperwork and suspicion that can derail your entire application. What about getting help from family? Absolutely. Gift funds are a common and accepted way to get the cash you need. But it has to be done correctly. The person giving you the money, the donor, will need to sign a formal gift letter. This is a legal document stating that the funds are a true gift, with no expectation of repayment. They'll also have to provide a bank statement showing they had the funds to give. It's a formal process, but it's a lifeline for millions of buyers. So you see, it's a three-headed monster of cash requirements. The down payment for skin in the game, the closing costs to pay for the transaction, and the reserves to prove your stability. Mastering these numbers, documenting every penny, and planning for them far in advance separates the people who dream of owning a home from the people who actually do. You've now proven your financial fitness on paper. You've documented your income, explained your debts, and demonstrated you have the cash to close. But all this preparation, all this financial scrutiny, is for nothing if the asset you're trying to buy doesn't pass its own separate, ruthless inspection. Because you're not just buying a home. The bank is buying an asset and they're about to put it under the microscope. This isn't about you anymore. Every document you've provided, every pay stub, every bank statement, that was just to get you in the door. Now the main event begins. The star of the show, the property itself, is about to have its audition. And the judge is a state-licensed, third-party appraiser who has absolutely zero emotional investment in your dream. Their only job is to answer one cold, hard question for the bank. If you default on this loan tomorrow, can we sell this house for at least what we lent you? This is the appraisal, and it is the single biggest hurdle that trips up qualified buyers right before the finish line. It's a step that feels like a formality, but it's actually a high-stakes valuation that can make or break your entire deal. The appraiser works for the lender, not for you, even though you're the one who pays for their service. Their loyalty is to the facts, to the market data, and to protecting the bank's investment. So what happens? An appraiser will schedule a visit to the property. They'll walk through with a clipboard, a laser measure, and a camera. They are not a home inspector. They don't care about the sticky window in the guest room or the dripping faucet in the half bath, unless that drip has caused a massive water stain and rotted the subfloor. They're not looking for minor flaws. They're looking for major factors that affect value. They'll measure the gross living area, confirming the square footage. They'll count the official number of bedrooms and bathrooms. A bedroom to an appraiser isn't just a room with a bed in it. It typically needs a closet, a window for egress, and a minimum square footage. They'll note the overall condition of the property. Is it pristine, average, or a fixer-upper? They'll look at the quality of the construction, the age of the home, and the functionality of the layout. They're taking stock of the big-ticket items. A 20-year-old roof is a liability. A brand-new roof is an asset. An ancient, clanking HVAC system is a negative. A high-efficiency unit installed last year is a positive. They'll look at foundational issues, the quality of the kitchen and bath updates, the condition of the flooring, and the overall curb appeal. Your personal decor? The color you painted the walls? Your perfectly manicured rose bushes? They mean almost nothing. The appraiser is trained to see past the staging and straight to the bones, the structure, and the permanent fixtures of the home. But the physical inspection is only half the battle. In fact, it's the less important half. The real work happens back at their office when they dive into the data. They are about to perform a complex analysis known as the sales comparison approach. They will hunt for comparables, or comps. These are recently sold homes that are as similar to your potential new home as possible. And the criteria for a good comp are incredibly strict. First, proximity. They're looking for homes in the same neighborhood, ideally within a 1-mile radius. A house 5 miles away in a fancier zip code is irrelevant. Second, time. They want homes that have sold within the last 90 days, 6 months at the absolute most. A sale from last year is ancient history in a fast-moving market. Third, and most importantly, similarity. They are looking for the property's identical twins. Same approximate square footage, same number of beds and baths, same age, same style of construction, similar lot size. They'll find the 3 to 5 best comps they can. Then they begin a process of adjustments. Let's say your dream home has a 2-car garage, but a nearly identical comp down the street that sold last month only has a 1-car garage. The appraiser will make a positive adjustment to the comp sale price, adding the market value of that extra garage bay to make it a true apples-to-apples comparison. What if the comp has a swimming pool and your house doesn't? They'll make a negative adjustment, subtracting the value of a pool. Granite countertops versus laminate? Small adjustment. A finished basement versus an unfinished one? A very big adjustment. After all these meticulous calculations, they arrive at a final number, the appraised value. This is their professional opinion of what the home is worth in the current market. And you, the buyer and the seller, just have to wait. It's a period of agonizing silence. Then the report comes in. In a perfect world, the appraisal comes in at or above the price you agreed to pay. If you agreed to buy the house for $400,000 and it appraises for $405,000, everyone celebrates. The bank is happy because their collateral is secure. The deal moves forward. You've cleared the hurdle. But what if the news isn't good? What if you agreed to pay $400,000, but the appraisal comes back at $380,000? This is where dreams die. This is the appraisal gap. The bank will only lend you a percentage of the appraised value, not the sales price. So, in this scenario, they will only finance the deal as if it were a $380,000 home. That $20,000 difference, that gap, suddenly becomes a massive problem. And you have 4 potential paths, none of them easy. Path 1. The seller agrees to lower the price to the appraised value of $380,000. In a buyer's market, this might happen. In a competitive seller's market, it's highly unlikely. The seller will probably just say no and wait for the next offer. Path 2. You, the buyer, come up with the cash to cover the gap. You'd still get your loan based on the $380,000 value, but you would need to bring an extra $20,000 in cash to the closing table on top of your planned down payment and closing costs. For most people, this is simply not possible. Path 3. Negotiation. You and the seller meet somewhere in the middle. Maybe the seller drops the price by $10,000, and you come up with an extra $10,000 in cash. This requires a willing seller and a flexible buyer, and it can save a deal that's on the brink of collapse. Path 4. The deal falls apart. You invoke your appraisal contingency, which hopefully your realtor included in your contract, you get your earnest money deposit back, and you walk away. All those weeks of work, all that emotional energy gone. You're back to square one, scrolling through listings. There is a 5th Hail Mary option. You can challenge the appraisal. This is called a reconsideration of value. But you can't just say, I think it's worth more. You need to provide concrete evidence that the appraiser made a mistake. Did they miss a key feature of the home? Did they use inappropriate comps from a different neighborhood? Did they miss a much better, more recent comp that supports your price? It's a long shot, and it rarely succeeds, but it is a final option for a deal on life support. The appraisal is the bank's ultimate reality check, stripping away the emotion and excitement and reducing the home to a number on a spreadsheet. It ensures that the lender isn't overpaying for their asset. Let's say you navigate this minefield. The appraisal comes in at value. You breathe the biggest sigh of relief of your life. The seller is happy, your agent is happy, you're picturing where the sofa will go. You've done it. You've passed every test. You think it's over. But it's not. Your entire loan file, now hundreds of pages thick with your financial soul laid bare and a property value stamped in approval, lands on the desk of one final gatekeeper. This person is the final boss, the one who holds the ultimate power to issue the 3 most beautiful words in real estate: clear to close. But they can also kill your dream with a single keystroke. And as they open your file for one last exhaustive review, they've just found something that every single person before them completely missed. It was a new credit inquiry and a new loan for $12,000. The buyer, so excited, so close to the finish line, had gone out the weekend before closing and bought a whole house full of furniture. They'd been offered 0% financing for 2 years and thought, why not? We'll need it as soon as we move in. To them, it was a smart, responsible move. To the underwriter, it was a live grenade tossed into a perfectly balanced equation. A heart-stopping email lands in the loan officer's inbox. Subject: urgent file on hold. The loan officer's blood runs cold. A frantic three-way call is made between the loan officer, the real estate agent, and you, the buyer. The agent is trying to keep their cool, but you can hear the panic in their voice. The seller has already moved out. The moving trucks are scheduled. Your lease is ending in 5 days. And the loan officer is explaining that your entire approval is now in jeopardy because of a new sofa and a dining room set. How can this happen? It all comes down to the single most important number at this stage of the game: your debt-to-income ratio, or DTI. We've touched on it before, but now it's the star of the show. Imagine your gross monthly income. Everything you make before taxes is a full pie. The lender has already calculated how much of that pie can be taken up by debt payments. This includes your new potential mortgage payment, property taxes, insurance, plus all your existing debts: car loans, student loans, credit card payments. They determined that with the new house, your debts took up, say, 43% of your income pie. 43% was the absolute maximum you were approved for. You were right on the edge, but you were approved. Now you've added a new furniture loan. Let's say the payment is $300 a month. That $300 is a new slice being carved out of your income pie. It just pushed your DTI from 43% to 46%. And the lender's automatic underwriting system flashes a giant, blinking, red light that says, "Denied." The underwriter doesn't see a new sofa. They see that the borrower's financial situation has materially changed since the initial approval. They see a new risk. They see a borrower who might not have the discipline to handle their finances, making major purchases right before taking on the biggest debt of their life. Their job is to protect the bank, not to make your homeownership dream come true. And right now, their computer is screaming at them that you are no longer a qualified borrower. This is the final critical checkpoint, the underwriter's last stand. And to survive it, you must treat the period between your initial approval and your closing day as a financial quiet period. A total lockdown. You are walking on financial eggshells, and the goal is to make it to the closing table without cracking a single one. So let's build the final and most important part of our checklist. Let's call it the closing gauntlet. These are the absolute do-nots of the final weeks. Number 1. Do not apply for any new credit. Period. No new credit cards, no new car loans, and absolutely no 0% interest furniture deals. Every new application dings your credit score and, more importantly, if you're approved, it fundamentally changes your DTI. It's the number 1 deal killer, and it's completely avoidable. Wait until the keys are in your hand. The furniture stores will still be there, I promise. Number 2. Do not make any large purchases on your existing credit. Don't go max out your credit cards on a celebratory trip or a new home theater system. Lenders do what's called a soft pull on your credit right before closing. They're not just looking for new accounts. They're looking at your existing balances. If they see you've suddenly racked up thousands of dollars in new debt, raising your monthly minimum payments, it can throw your DTI out of whack just like a new loan would. Live like a monk for a few weeks. It's worth it. Number 3. Do not change jobs. This is a huge one. Lenders value stability above almost all else. Your entire approval is based on your current, verifiable income from your current employer. If you switch jobs, even for a higher salary, it sends up a massive red flag. The underwriter now has to re-verify everything. They'll need new pay stubs, they may need to see a history at the new job, and if you're moving from a salaried W-2 position to a commission-based or contract role, you can almost kiss that loan goodbye. If you have an unavoidable job change, like a corporate transfer, you must inform your loan officer the second you know about it. But if you have any choice in the matter, stay put until after you close. Number 4. Do not make large undocumented cash deposits into your bank accounts. We talked about sourcing your funds, and this is where it comes to a head. If your grandma gives you $5,000 in cash as a housewarming gift and you deposit it, the underwriter will see it on your final bank statements. They will demand to know where it came from. It was a cash gift is not an acceptable answer. All funds must be sourced and paper trailed. If you're receiving a gift, it needs a proper gift letter and a paper trail from the giver's account to yours. Unexplained cash looks like an undisclosed loan to an underwriter, which is another form of debt they haven't accounted for. Number 5. Do not co-sign a loan for anyone. Not for your cousin's new car. Not for your brother's new apartment. When you co-sign, you are legally 100% responsible for that debt. Even if you never make a single payment, that debt now appears on your credit report and is factored into your DTI. It's a guaranteed way to throw a wrench in the gears at the last possible second. Just say no. You can be the hero after your loan is closed. And finally, number 6. Do not miss any payments on your existing bills. It sounds obvious, but you'd be shocked at how often it happens. People get so wrapped up in the stress of moving that a credit card bill or a car payment gets overlooked. A late payment in the month before closing can drop your credit score dramatically and is a giant red flag for underwriting. Set everything to autopay. Double check it. Don't let a $20 late fee cost you a $500,000 house. So what happened to our buyer, the one with the brand new furniture loan? It was a nightmare. The closing was delayed. The sellers threatened to walk. The moving truck had to be rescheduled. The loan officer spent 2 days on the phone with the underwriting manager, pleading their case. The buyer had to provide proof that they could and would cancel the furniture financing immediately. They had to sign affidavits. They had to get new statements from the furniture company showing a zero balance. And only then, 48 agonizing hours later, after rerunning the numbers a dozen times, did the underwriter finally reluctantly issue the 3 most beautiful words in real estate: clear to close. They made it by the skin of their teeth. But the stress, the fear, the extra cost of delaying everything, it was all avoidable. And that's the whole point of this journey we've been on together. From the very first step of checking your credit score to understanding your true budget. From gathering your tax returns and pay stubs to getting that pre-approval letter that makes you a serious buyer. We've talked about finding the right agent, hunting for the perfect house, and making an offer that wins. We've navigated the maze of the loan application, the inspection, the appraisal, and the title search. And we've now survived the final boss, the underwriter. This isn't just a checklist. It's a roadmap. It's a system to turn one of the most stressful, complicated processes of your life into something manageable, understandable, and successful. Homeownership is more than a transaction. It's the foundation for your life. It's where you'll build memories, where you'll feel safe, where your future will take root. And getting there shouldn't be a matter of luck. It should be a matter of preparation. You now have that preparation. You have the knowledge to walk into this process with confidence, to ask the right questions, to avoid the common pitfalls, and to put yourself in the strongest possible position to get the keys to your new home. The American dream is not dead, but it does demand your attention, your diligence, and your respect for the process. You are now ready to give it all 3. Go build your foundation.